I'm Ross Mayfield, an investment strategy analyst at Baird, and we are back for another weekly video with our friends at Strategas. Today, we're thrilled to be joined by Strategas chief economist, Don Rissmiller. Don, how are you doing this morning?
Very good. I've been traveling a bit out here in San Francisco, so I'd say the flight was getting full, maybe not full, but getting a little more full. And the hotel isn't full, but it's getting a little more full. So you can start to see the improvement being out and about.
Well, good. Well, that's a perfect segue to our conversation about the economy and the world and how everything's looking right now. You all do an exercise every month where you categorize some key economic sectors as assets or liabilities, and you just released it. I thought it would be a good framework. It was a little bit, more negative, but we'll finish on a positive. You downgraded price inflation and wage inflation to liabilities, and those have been concerns for a bit. So I wonder why now. What are you seeing that made you make that change?
So most of what we've seen this year can fit into the transitory camp when we look at inflation. So the big surge earlier in the year was in things that were related to the reopen. So car prices, used car prices, rental cars, hotels, airfares, these type of things were related to reopening the economy quickly, and we ran into bottlenecks. It wasn't surprising that we ran into some bottlenecks. What's somewhat surprising is how long those bottlenecks are lasting, and in some cases intensifying. So as we sit here in October, these bottlenecks are not gone. When we look at the auto sector, they're likely to linger well into 2022 due to the issues with semiconductors. So what we're seeing is the inflation is starting to get sticky. So it's fair to say high prices are not rising prices. So if you have a surge in used car prices, that will flow through the numbers. And if we sit here a year from now, that'll difference itself out. But we're starting to see inflation expectations creep up. That's both through the survey data as well as market data. If we look at, for instance, the University of Michigan survey, we like to look at the 5-year number rather than the 1-year number. So the longer term inflation expectations. But either way, they're rising. The New York Fed also has an inflation expectation survey that is moving up. And so relative to their own history, these series are starting to move. And we're starting to see some of the components that we really care about, like rents, turn as well. Rental inflation is closely correlated to the labor market. It's closely correlated to permanent job loss. And as permanent job loss has started to come down, rental inflation has started to pick up. And these are very smooth series. They don't bounce around a lot like some of these other components that we talked about. So when you get a turn, it tends to be a durable turn. And that's what we're watching.
So one of the other downgrades was consumer confidence, and those numbers have been kind of weak for a while. Is it fair to say that's kind of a read through on what's happening with inflation? Do you think that's mostly driving those weak consumer confidence numbers?
I think there's two things. I think inflation certainly was part of the story over the past few months. We saw the Conference Board survey released recently falling again. We've seen that in the University of Michigan survey as well. This is likely reflecting some of the health concerns over the past few months too. So I think it's inflation and the Delta variant that are both in those numbers.
Yeah, it can never get too far from worrying about COVID, I guess, despite all the other headline risks out there. So let's flip it. On the flip side, business confidence, kind of mirroring consumer confidence, is actually an asset. We know there's been some issues with hiring and wages, but business confidence remains positive. Could you talk about that a little bit?
Yeah, so there's a difference between large business and small business here as well. Large businesses look like they've, for the most part, started to adapt to this environment. So, for instance, some of the new requirements have already been implemented by some of the larger businesses. So there's nothing new in the way business is being done. And so large businesses are here in a position where they can see global demand, and often they are involved in many different countries. There have been problems abroad, but these problems are on the supply side. So if it's a factory in Vietnam, if it's the transmission of goods across the world, we know that that's backed up. But we also know that new orders are quite strong. And so there's some visibility as labor shows up, as supply shows up, to believe that there's going to be some strength going into 2022. So the type of problems we're having are really problems where we can't fulfill the requirements that the economy is giving us. So the demand is there. It's the supply side that's been a problem. And especially larger businesses are trying to look through that and trying to make plans for next year. Now, that's easier when you have profits and margins doing what they're doing. For smaller businesses, it's a little more challenging. And certainly there have been issues over the last month with how business is going to get done, especially in certain cities. But again, these are the type of things that we tend to work through. So we'll see if business confidence changes, mirrors consumer confidence as an example. But right now, it looks like we have demand. We're just not able to get supply where it needs to be. And those are the type of things that the economy usually works through.
Yeah, it's, the consumer being such a big part of the economy, it's always good when the demand is there. That's a good place to start from. And I should say, the gauge turned a little bit more negative, but overall, your assets and liabilities still remain positive. So we'll be on the lookout for the next update. Hopefully, get some more upgrades. And I would say I really appreciate the time, Don. Thanks for joining us today.
Sure, happy to be here. Thanks.
Great, thank you.